There we go. Hello, welcome everybody. We're excited to have you here. Excited to see all these names. Ginny, we love Ginny. Jesse. Oh, it's so good to see you guys. Jean, man, we know all of you guys. This is awesome. Yep.
Dee, good to see you. Brian as well. I love it.
Oh, it's so good to see you guys. So we'll give just a couple minutes to let everybody filter in and get comfortable before we get started. Now, I know that some of you tried to get on our webinar yesterday, but we actually hit capacity. So we decided to open up another one today so that we can make sure and get you guys taken care of. So thank you for being patient. Thank you for waiting until today, but we're excited to go over all of the fun information that we have. So I'll go through kind of what you guys can expect, a little bit of the outline, but before we do that, I want to introduce you to Tyler and Ryan. They are our panelists here. We're super lucky to have them. And we'll go into a little bit of, who they are. Although I'm sure you guys know exactly who they are. But for those of you that don't know me, I'm Melissa Forbush. I'm the investor relations, the VP of investor relations for MF Capital Partners. Now, because yes, I am with investor relations. However, tonight, you guys, I'm one of you. I'm here as a passive investor. So I'm not going to be investor relations. I'm going to be like Jesse, sitting in our house, ready to grill these guys some questions. So we are going to do a little bit of a Q&A as well. And I'll kind of go over that. But I have questions that I know you guys are interested in hearing the answers to. So I'll go over those first. But just a reminder, if you have any questions, make sure to put those in the Q&A. So obviously you guys can chat with us in the chat, but just to make sure I keep all of your questions in one place and make sure to get them answered, make sure to put them in the Q&A. If you don't know how to do that, it's just on the bottom right-hand side. So now I'm going to go ahead and get started. So I'm going to tell you a little bit about the flow before we introduce these two gentlemen, these two handsome gentlemen on here. So I kind of mentioned we're going to go over the Akahi Fund. This is why we're here. We're excited to talk about this opportunity and get you guys all of those details. So that's what we're first going to do. Then we're going to go over those questions that I told you that either I've been grilled or as a passive investor myself, I know that you guys are going to want to hear. After we do that, we'll open it up for a Q&A, and that's where you'll want to make sure to put your questions in the Q&A section at the bottom. But then we'll talk about next steps. So at any time during this process, if you're wanting to skip over us and just go and reserve your reservation, you're more than welcome to do that. We will be putting the link in order to do your reservation in the chat. So, and we'll also be sending that link out as well. So again, a lot to go over, but the most important part, these phenomenal panelists that we have. We're incredibly lucky. I'm going to start with Ryan. If you know Ryan, y'all respect this man, no question. So I want to see in the chat if you do know Ryan, because this man is incredible. If you know him, you know he's a wealth of knowledge. He's absolutely critical to our team. And he wears lots of hats, but most of all, he's our incredible underwriter. He helps us really develop our strategic operating plans, obviously amongst other things, but overall, it's optimizing investor returns, which we all want. So, Ryan, you see this chat blowing up, right?
Hey, it's not blowing up like it should be, though. Everybody get quicker on that dial. We got some slow typers today. Slow typers. So good to see everybody on that chat.
One thing that you guys may not know about Ryan is he's actually the co-founder of Multifamily Mindset. It's an education company where these guys get to really help new and seasoned investors. So again, if you know Ryan, you know that he is passionate about serving others, and this is a perfect platform for him to share his passion, multifamily real estate. So he's extremely passionate, as I'm sure you all have had a piece of. I know I definitely have. But Ryan, I'll turn it over to you if you want to touch on your background, experience, whatever, or if you just want to share. What do you want to share, Ryan?
So much to share, Melissa. Yeah, thanks so much, for the introduction. Yeah, a little bit about me is, I grew up in California, and I grew up with a grandfather who, introduced me to this business. He owned quite a few apartment complexes, and I really didn't know that at a young age. I just saw what the wealth, generational wealth created, and it was through apartments. And I realized that in my, early 20s, that's what I wanted to do. And I got into single family and started flips, like many people have done, right? And I realized, man, that's not how my grandfather did it. He created generational wealth. Just like what a lot of our investors want. They want generational wealth for, their kids, grandkids, they want that to carry on down. There's no difference between us and them. So I realized that in my late 20s that, multifamily is the direction I wanted to go. Because of that, I got a degree in accounting. I've always been a big fan of numbers, not only numbers, but like what the story that numbers tell, right? Numbers all tell a story, which has allowed me, in this business to see, how that works into the operations of properties, right? And how that works, and it's allowed me to be able to forecast, and so I got that degree in accounting, and Tyler and I created this business. I've known Tyler for 15 years. We've created multifamily capital partners 7 years ago now, Tyler. It's 7 years now, huh? I've known Tyler for about 15 years, so the time goes by fast. So we've done that and had tremendous success, which is exactly where we're at today, is creating a fund.
Awesome. I love it. So if you guys have known each other for 7 years, how old? I mean, are you guys old?
15 years. We're getting too
old.
old.
Sorry.
Ryan knew me back when I had hair, dude, and he didn't have so much gray hair. It was a long time ago.
A lot of things have changed.
You just exchanged wisdom for, you lost hair, but you gained wisdom. Is that how it works?
Absolutely.
I hope that's not how it works. Well, I want to make sure that we introduce this other man who does not have hair, but he has a lot of incredible features. So Tyler is the managing partner at MF Capital Partners as well. He is our face. I'm sure you guys see him absolutely everywhere. Honestly, he keeps us all in line. So I've known Tyler for what is it now, Ty? Is it longer than 15 years?
Your whole life, man. Your whole life. I've known you your whole
life.
Long
time. Yep. I've known Tyler for a really long time, which means you guys can give me your condolences or your praises. Because I'm incredibly lucky to be able to work next to this man every day. So we're incredibly lucky to have these two. Ty, do you want to add a little bit about you?
No, man, just excited to be here. Grateful for each and every one of you for jumping on. That's the first time I've, heard Melissa. I like to hold as many webinars as possible so that Melissa's kind of forced to say some nice things about me, which I love. But sincerely just grateful to be here, walk you through the fund and answer any questions you may have. But just humbled once again. I mean, yesterday was a humbling thing to be. It's the first Zoom call that we've ever, maxed out capacity on. And so once again, just humbling and grateful to have you all on here today as well. And hoping that I can, answer any questions that you have. So I'm good.
Sweet. I'll go into a little bit about our company. And I know that obviously they talked a little bit about the experience, but our company has, our portfolio is 230 million and a little over 2,200 units. And obviously with that comes a track record. We've had a lot of learning lessons. We've had some incredible properties, but most importantly, we have learned how to roll with the punches. How are we going to be creative and step outside of the box? And really that is what has gotten us our success. So we're excited to share that with you guys. And with that, I'll dive into why we're here, the Akahi Fund. So before I go into the details, Tyler, I want you to explain what Akahi means. Why did we call our fund Akahi?
You actually stated it pretty good too. So I live out here in Maui. I saw somebody in the chat ask where our company's located. I live here in Maui, and Ryan is in Orlando, and we have another office in Utah that we're actually relocating to Orlando. So, and that's where Melissa is in Utah. And Akahi is the Hawaii word for one. Okay, so for one. So you're going to see you're going to learn a whole bunch of Hawaiian numbers as we go through this, because I just saw Koa said he's Maui born. I love that, man. Love that. Grateful to be here on island for sure. So yeah, Akahi stands for it's Hawaiian for one.
Awesome. Sweet. So the Akahi Fund, this is our first fund, so we're extremely excited to share with you just the structure. It's not your typical fund structure, and we did this because we have some amazing investors that have followed us through property after property after property, and we want to make sure that we continue to take care of them. So you'll see that this structure is different than you would typically find. So our different classes that we're offering with this opportunity. We have 2 different options. We've got a 6% preferred return for a lower amount invested in, which is the minimum is 100,000, and that gets us a 6% return. Or I'm sorry, a 6% preferred return, and then also targeting 16 to 18% annual rate of return. And then we also have an 8% option for a higher investment amount. That investment minimum is 200,000. And again, that gets you equity on the back end as well. We're targeting between 18 and 20%. So those are the high level overview, but the most exciting thing, the most exciting option that you guys have with this fund is the ability to have your capital back in the 3rd year. I don't know about you, but I've never had an investment where I get to have my capital returned and keep my ownership. So we'll go into a little bit more detail about that later, but to give you a little overview, we are projecting to not only give you your capital back, but allow you to have your ownership continued in that year, or I'm sorry, in that fund, which obviously equals, what is it, Ty? What's the word that we can't say?
Well, I'll ask them, man. If we return all your capital back to you and you still participate in cash flow and equity, what is your return past there? You type it in the chat, see if you know. What's your return past that? If we've given you your investment capital back and you're still owning the fund and getting cash flow and equity from there. Throw it in. There we go. Yeah.
Caitlin got it.
You on here. It's infinite. But yeah, once again, the SEC doesn't allow us to say infinite. And so it's 16 to 20% projected annualized rates of return. That's how it works. So.
Awesome. So we are extremely strategic in the markets that we choose to invest in, that this fund will actually be a part of. So we'll talk a little bit about that as well, and you'll see why we're extremely strategic. So we're going to go into, what is it that makes us interested in markets? Obviously, there's the migration patterns. It's the fundamentals, the city, cost of living, employment, income. We take everything into account. So we'll share a little bit of that. But because of these amazing markets, we will be targeting assets across the Sun Belt. So we're investing in Houston, Dallas, Austin. Everything's bigger in Texas, right? But we're also going to be investing in Central Florida, North and South Carolina, Georgia, and also Oklahoma. So as you can see, we definitely take into account which markets are booming, where are they at in the market cycle, and we do all of that for you guys, so you guys can enjoy the passive income and not have to take your time and have to do all of the research. So we take care of it for you. So I kind of mentioned the minimum investment is 100,000. And then that preferred return is between 6 and 8%. And then obviously the 8% is for the higher amount invested, which is a minimum of 200,000. Now, there is a limited availability. Tyler mentioned our webinar last night. We reached capacity. So we've definitely, I think we're at 87% subscribed. So if it is something that you're interested in, remember that it's a first come, first funded serve, however you say that. So we definitely want you to make sure that you get in and get your subscription finalized if that's something that you're interested in. So next thing, our next steps, I kind of mentioned. Now, these are the next steps to complete your investment.
Melissa,
Yep.
to interrupt real quick. Have we thrown Tasha's already over. I was just going to say, throw that link in there so they have it. But sweet, sorry, keep going.
Yep. So you'll be able to click on the link that you guys should have access to. It will ask you to make a soft commitment. And then after that, you'll be sent an email with a link to finalize your subscription documents. You'll be able to view the PPM and then sign electronically. And then to complete your reservation and really hold your spot, you'll just need to wire your funds by May 6th. So Drew, or we will send you the link. It's actually right above you. It should be.
If they can't see the chat, I wonder if they can't see it, because I think
Here,
that it's just for the panelists.
There you go. Oh, shoot. There you go. Tasha, I think we'll make sure that we keep sending that out for sure for everyone. Tasha, will you send that? Mine won't paste. But if you have any questions while you're going through that process, feel free to reach out. You'll actually see on that link, it'll have our contact information. So our investor relations team they're more than happy to jump on a call, answer any questions, and really help you with that process. So with that, we'll kind of dive in, if that's okay. We'll kind of show you. We'll dive into really the people behind the scenes, the people that really, are the ones that are really helping with this investment and making sure that we get you the best returns possible. So you already know Tyler and Ryan. We're gonna hear from more from them in just a few minutes. But the people that you may not see all the time, Todd Miller, incredible. So he's the man behind the scenes. He's operationally, Todd is tasked to keep all business, education, investments up running efficiently and effectively, but also that ensures profits and sustained success, and making sure that that's obtainable. So obviously that you guys know how important that is. And then you see me, I don't look as great as the gentleman that I have to be next to, but
I'll introduce Melissa. Melissa's in VP of Investor Relations. Her and Tasha will be y'all's best friend, man. They are absolute rock stars in everything they do with managing communication with investors, organizing all your subscription documents, getting you reports, taking care of everything, man. They're amazing. So shoot them some love. And we're just grateful to have Melissa up there. She makes us all look better. So no, grateful for Melissa, Tasha, all the rest of the team members as well. So
thanks, Tyler. So we kind of touched on this. We have two major offices. We're relocating from Utah to Orlando, but then we also have the Maui office. I don't know how Tyler got stuck with the nice Maui office with the beautiful weather, and I got stuck with the snow and the cold. but we are looking forward to moving our office to Orlando. So right now we have 17 key team members. You'll see there are a bunch of people right here. These are all the individuals that help with acquisitions, asset management, operations, and really that girl right there up at the top left, Tasha. She's my girl, guys. She really keeps me sane. I honestly don't know how I would deal with these nuts without her. No, she's incredible, you guys. She actually has a background in real estate, but she also has a background in relationships, which is what we need for investor relations. So I'll kind of give you a little bit more. I mentioned a little bit about as a management team, we have a little over 2,200 units, but we are in 6 states, like we mentioned. So not only are we looking at the market cycles, we already have boots on the ground. We have operations in a lot of those states. So that's going to drive our interest as well. But most importantly, the most important metric that y'all are interested in, we have created 73 million in equity for our investing partners. And we're extremely proud and grateful of that. That's our focus. So I'll kind of jump into.
Tasha got everyone the link too. So thank you so much, Tasha. You're amazing.
So. Yes, thank you. So last thing I want to clarify is we don't take projections lightly. My Siri's talking to me. She's saying projections. What? Oh, there we go. We'll get Siri out of here. So I want to clarify. Our team does not take return projections lightly, which is why we are extremely conservative. This is where Mr. Ryan Woolley comes in. He is incredible making sure that we continue to under promise and over deliver. We know how important that is. So here you can see, this is our projected average returns and then our actual. So this is what we actually pay our investors versus what we're going to tell them we're going to pay them. So we're excited to help put even more investors' capital to work, and we look forward to adding you to that list. So are you guys ready?
Yeah.
Ready to dive in?
I'm ready. I'm
Listen,
ready.
I'm ready to grill these guys. So, like I said, first, I'm going to ask the questions that I've prepared that you guys have asked me. But just a reminder, put your questions in the Q&A and we'll get to you. I promise. So first, Ryan, you're in the hot seat. I want to know, what is the difference between an individual syndication that some people might have experience in or be used to versus the structure of the Akahi Fund?
Yeah, great question. I think we've gotten that quite a bit lately is, what is the difference? A syndication, we're going to take down one deal, right? And one deal only, and that's all you get to, to take advantage of. The reality is we're working on several different deals all the time. Some of them are cash flow deals, some of them are equity deals, and so, creating a fund allows us to go out and buy, 4 or 5 different properties within this fund that allows you to capitalize on cash flow, equity, all of those. For example, we have 4 different properties we're selling off in Columbia right now. Those range, I think they're averaging 38, 40%, something like that altogether, right? 30 to 60%, I think it is the returns on those. Well, guess what? Some of them are cash flow, some of them are equity. I was just talking to one of our investors today about that, Doug. We're talking about, one of them is close to 60%, the other one's 30%. Well, guess what? If you were in that 30%, you would have never seen the 60% one. So now you get to take advantage of these other properties that we target that are cash flow and equity properties to put in that portfolio with you. So that's what the Ekahi Fund is. That's why we've created it.
Sweet. So Tyler, with what Ryan said, what makes that different from a REIT?
A REIT. So a REIT's a real estate investment trust. If you guys don't know, and a REIT is a privately or publicly traded company, right, that owns and manages real estate. So it's actually fairly similar to, it could be very similar, but it has some major differences, right? So a REIT, you're not necessarily investing into this specific project, or you don't really own a portion of the properties. You're investing in a company. And I say the Akahi Fund is similar because you are investing with us as a company, right? You're trusting us and our ability, given our track record, to go and acquire properties. But there's a major difference there, which means the major difference is you actually own a percentage of those properties, which means you get a benefit from everything that real estate has to offer. So for me, yes, cash flow, yes, equity, all that upside is awesome, but I also want to keep the money that I make. And the tax benefits with multifamily, by owning a percentage of the property, a fraction, of those properties, multiple properties, tax benefits are beautiful thing. So that's the major difference, is that yes, you're investing into a fund, but you actually have fractional ownership into all those properties. So you benefit from every aspect of real estate, which is beautiful.
So you mentioned that you feel like the Akahi Fund is one of the best investments someone can make. So tell me why you feel that way.
Well, a whole bunch of different reasons. Like, obviously it's because it's our fund. So, and we're pretty badass. So, that's, a given, obviously. And by we, I mean Ryan, Melissa, the rest of the team, and I get to tag along, which I'm pumped about. So that's number one. But man, it's because everything that I know what we do, right? I know what we do on our end. Like running a business, any business, there's obviously challenges. Like, any business, there's challenges, but it's our job to handle those. You look at, a number of you I see just in the chat and everything. It's so fun to see everybody. Gene and I think I saw Jessica's or Jesse as well, and just a bunch of you that have invested in past deals, and that the number one factor of deal performance are the operators. That's us. And so I look at some of these past investments. Village East, we're about to exit, and Village East, man, there's tons of challenges on Village East. Like, we bought right before coronavirus, like literally right before. And then we had a fire at the property, and all those things could pose challenges. We had some partners that we wanted to operate certain ways. They wanted to operate certain ways. So there's challenges behind the scenes there. But y'all didn't know about any of those things. You knew about the fire. Obviously, we keep you updated on those things. But those other challenges you don't know, right? So Prosper Fairways is another example. We're exiting that property as well. That property had some crime, and then we had to fire. We actually had to fire our management company on, what was it, Ryan, 4 4 properties in the Carolinas?
Yeah, 4 properties.
And that's a challenge, man. But here's what's crazy. Once again, a lot of you are maybe investors on some of those and you have no idea that those weren't necessarily big challenges. And it's because you didn't, you might have been aware of the struggles, but you didn't worry about them. You didn't stay up, and think through solutions and, to those problems. But you did continue to collect cash flow checks and equity checks. And, how is that possible? Why is that possible? It's because of what we do as an operating team. Ryan, we're exiting Prosper Fairways as an example. What's the annualized rate of return that we're getting investors on Prosper Fairways?
Annualized is close to 50%.
50%, exceeding the expectations. Village East what was Village East again? Ryan's the numbers guy. He keeps me on track there.
Village East is was 25, 26% annualized. Yeah.
All of those exceed projections, right? So it's super, super powerful. But as for the fund benefits, there's tons of advantages. There's tons of advantages on the investor side and as well as the operator side. Like I look at our job. Our job is to bring the best deals with the most amount of upside and, the as little downside as possible, right? So real estate's obviously a risk and it's our job to mitigate that risk, but there's a number of upsides. Like upfront negotiation would be number 1, right? It just, I don't know, as I'm listing these off, not in order of preference or priority, but upfront negotiation is huge because we're able to now take our track record, our relationships, and we have the capital ready, which means it makes us very attractive to the sellers, which means we're able to negotiate better deals. We're able to lock in better rates, and all of those things obviously turn into better deals with more upside and less downside. Diversification, Ryan mentioned, and I think that's one of the biggest. You're able to diversify your investment over multiple properties, which once again allows you to benefit and also protects you as well. It also saves you from decision fatigue. Like one of the biggest reasons that we decided to do this is we looked at these investors, and Gene, I know you're on here, and Gene, this is one of the conversations I've seen through texts and conversations of just like, man, this decision fatigue, what deal should I invest into? And now by investing in, you get to capitalize and benefit from all those deals. It's beautiful. And then tax benefits. If you don't know, there's tons of tax benefits I mentioned earlier, but bonus depreciation, cost segregation, depreciation period. And this year 2022 is the last year for bonus depreciation, 100% bonus depreciation. And if you don't know what that means, all that means is that you get to capitalize off of cash flow and you don't pay, it's not an exact science, but you hardly ever pay taxes on that cash flow, which means you get to keep obviously more money that the more that you make. And then one more that I'll say is, I think super prevalent right now is a hedge against inflation. You look at inflation is like 8% range for headline CPI, and 8% is just the, what they'll report. It's higher than 8%. But so today, if you think about that, like if you say you invest in the stock market and you get a return of 8% as an example, well, that really is a return of 0 because all you're doing at that point is just keeping up with inflation. So that's a big deal. So in other words, we have to grow our money by 8% just to maintain buying power, right? So this is a hedge against inflation, investing in this fund with, multifamily assets. It's super prevalent and important in today's environment, in my opinion.
So I want to pull out something that you said, Kai. You talked about how you've seen investors like Gene or anybody else really have, decision fatigue. You guys, I want to point out, pick operators who listen, who identify some of these struggles that y'all go through and want to make those changes for you. I think that is extremely powerful and something that probably a lot of people don't even realize what's happening behind the scenes. But you have, Tyler and Ryan who hear some of these struggles that our investors have, and they instantly say, okay, we go to bat. How do we figure this out for them? How do we make it so that they can get past the decision fatigue? So
one more thing with that I'll mention is like, we'll never claim to be perfect. We are far from perfect. And, those of you who have been invested, we have investors who have invested with us literally on every single deal. And a number of you, obviously, that I've already mentioned that I see on here, you can attest to the fact that we're not perfect. But I'm sure you can also attest to the fact that we listen to feedback. Like, we want it to be a better user experience, meaning experience on your end. And that's obviously probably why you're still here and continue to invest, which we're grateful for. Very, very grateful for. Always will be.
So I want to make sure that I go back to what you were talking before I interrupted you. But you were talking about inflation, which is, it's huge right now. Obviously, all of us see the news. We all see what's going on in our areas, in areas that we're investing. So how do we beat inflation?
I'm just going to tell you right now that I have Jackson behind the camera here. And Jackson, I asked Jackson before to get,
we can hear, we can hear Jackson laughing.
I asked Jackson to get a picture for social media, and he just crawled under the desk, because if he came around this way, he'd get in the camera. So I just am watching him crawl under the desk behind the scenes, snap a picture, crawl back. Dude, we just give Jackson a round of applause, man.
I'm sorry for the distraction. My apologies.
So awesome, man. I loved that so much.
That is amazing. That's
so
a
how
real
do we beat? No question. So how do we beat inflation? What do we buy? Appreciating assets. You know, it's what I love about apartment buildings. As inflation goes up, if you think about it, so do the rents. So as long as inflation is happening for the right reasons, which is economic growth, which is exactly what is happening right now and why inflation is so high. So commercial real estate's valued by the income. So as paper money decreases in value, our real estate goes up in value. This is why we call it a hedge against inflation, right? So powerful, absolutely powerful. So I hope that answers that question.
And as you're saying that, I realized that my light isn't on. My NFCP light. No, I'm dropping the ball here.
Get it together.
I get you guys blinded by the light. Oh, there we go. All right, Ryan, now that my light is on and glowing, I can move it to you. I have a question for you, sir. I know that you are always forecasting. So I'm curious, are you nervous about the upcoming recession?
Oh boy, that's a good question. Listen, this has happened, throughout history, right? There's always a recession that happens. My grandfather, in buying apartments, towards the, in the 70s, into the 80s, the 90s, right? It all happened, right? And he still made money, but why did he make money? Because he's always forecasting. He's always looking ahead and to see what happens. Right now, a lot of people see what's going on with, interest rates going up. Now, that's not something that we just did this week, right? We were looking at this 6 months ago, and look to see what types of properties we were getting into. We were talking to lenders. Hey, what are you seeing? What's going on in the market right now? What types of properties should we look at? Hey, what's going on in this market? Are you guys lending in this market? Are you not lending in this market? Right? You just saw that, what we just did. There was 1.7 million new jobs, right? Now it's funny because everyone might say, I love Tyler with this because Tyler's always, helping us out with our mindset. He's always saying, you can look at the problem or look at the solution. Some people might say, well, hey, COVID, they lost their job during COVID, so 1.7 million jobs. Listen, the fact is 1.7 million people are back to work, right? So they're paying their rent. But it's funny, I just read an article the other day that said, that property homes, residential homes will go up another 22 to 23% this year, right? This year, people aren't able to really afford getting in a home. So where are they going to go? They're going to rent, right? They're going to get in a multifamily. Yeah, there's going to be people that can still buy, right? There's always going to be people that can still buy, but it's pushing more and more people into the renters market. Then you look at, the Human Resource magazine just said over the next 5 to 7 years, 70% of the market, right, are 20 to 30 years of age, right? What are they doing? They're all renting. They're being pushed in so that recession is not affecting them because they've made the decision that they're going into multifamily, right? So no, does a recession bother me? No, right? Because I don't focus on the problem. I focus on what is the solution.
I love it. And listen, I love how that question was posed. Are you nervous about the upcoming recession? There's no guarantee that there is an upcoming recession. And I believe that there's differences, right? Recession versus correction. So a recession historically happens every 30 years historically, obviously approximately 30 years. But a correction, well, that happens historically every 12 to 15 years. And so we're always forecasting those kind of things. But a correction, a true correction is a it levels out. That's what I'm looking for, levels. I'm like, this is the international sign for levels. Levels out.
I knew what you meant.
But it's once again, it's what's the solution? How can you make sure that people like us, I'm just going to tell you right now, we're going to buy. Like interest rates, people talk about interest rates and they're like, man, what if interest rates go up? Well, interest rates are already going up. That doesn't mean that people stop buying. That means people that buy with solutions. I'll tell you what it does mean. It does mean that those people who are nervous or scared, they maybe hold back for a minute, which gives us now the ability to go in and negotiate even stronger deals at that point. It's an upside, man. It's an upside if you look at it and find the solutions behind it, in my opinion.
You know, Tyler, you just said something there, man, that sparked something. Is you said that during inflation, and one of the reasons we created the fund is people have scarcity, right? To jump in. Now we can go and buy more properties. What were the words that you said? They are they're scared to make the investment, so it allows us to go in and make the investment. I can't remember exactly.
Yeah. Me neither. But I think that's close enough.
Something along those lines, right? You know, it's you know, the fear mindset. And I think about people that are scared during the recessions. You look at what, 99, you look at 87, you look at 2008, right? Who made money? It's the people that invested, right? You know, they invested in real estate during the right times, right? And they made money. And it's interesting to me is that, you know, I have a brother of mine who you know, he refuses to invest, right? He refuses to invest because he got burnt years ago, right? In 2007, 2008, got burnt, you know, and we've talked to him about all the investments that we've done, right? And he's still nervous and he doesn't do it. And so why? Because he's afraid of the recession. He's afraid of something that's coming in the future, right? You know, and he doesn't, you know, rely, like what you said, Melissa, on operators who are doing all this work for them, who are forecasting, who are looking ahead, who are getting with lenders to see what's going on. You know, we're not just going into every single market. We're going to specific markets that Melissa talked about for certain reasons, right? That's what has allowed us to get the returns that we've got.
Agreed.
Absolutely. So Tyler, you mentioned that each property and market has to pass, I think you called it a stress test. So what are the stress tests? Are these different investments that the different investments have to pass?
So I feel like that question is perfect because it parlays right off of what Ryan was just talking about. Like being able to understand how to get into a market early, but also understand the market fundamentals, what's actually happening in the market to know what market you're going into. So high level, I'll go high level so I don't nod y'all off to sleep. Okay. Melissa knows and Ryan knows too. I geek out on this kind of stuff. I love market stats and all this kind of stuff. But it's because it's powerful, you know, it's very powerful. So we look at a couple, I would call them 4 major buckets. Okay. We look at employment metrics is very, very important. Population trends, local and state government policies, procedures, laws, regulations, stuff like that. And then also supply and demand. So employment metrics, you look at that one first. You know, why is that important? Well, tenants need a job to be able to pay rent, and jobs also bring people to the market. And so it's probably one of, if not the most important key metric that we look at, job growth. And we're looking for 2%, we call it year over year job growth, okay? So meaning we look at markets that have at least stagnated and then hit 1%. That's how we get in early. That's why we've been able to jump into these markets early as well. But also 2% year over year, meaning that it's continually increasing each year by 2%. We also look at job diversity. And that's a big one that I think a lot of people overlook. Like we look at markets where there's not any single industry that owns more than 25%, meaning controls 25% of the job population. I feel like I'm not saying that correctly, but I think you know what I mean. And 20% is even better than that, you know? And so I saw a couple in the chat that were asking, do you have properties already slated to go into this fund? Absolutely, for sure. We have one in both of them that we have already that we're taking down. Literally, we're already under contract, moving towards close right now. And they're both in Texas. One's in Waco, one's in Houston. And I'll compare it to Houston for an example with this job diversity. Houston, the industry that owns the biggest percentage of jobs in the market is the trade, transportation, utility type sectors. And right now they're at about 20%. So I told you we target areas that have no one single industry has more than 25. The biggest in Houston has 20, and that's massive. Houston's a great market for job diversity. And then we also look at unemployment to round that out. You know, obviously, if unemployment's decreasing, that's phenomenal. That's ideal. If it's increasing, that's not ideal. We also look at population trends. Most importantly is what we call household formations. So that's actual households that are forming. We target 2% year over year. And then the local and state government aspect of it was just essentially, we need to know how much control we have over our business, essentially, right? How long it's going to take us to evict tenants. Can we evict tenants? What are the rules and regulations there? And then lastly is supply and demand. And, you know, supply and demand, that's economics 101. You know, you understand supply and demand, and you'll have a good understanding of just the overall strength of the apartment market. And I'll compare it to Houston one more, and then I'll turn it over, or else I'll get too in detail. And I get, once again, I just geek out on it too much. I can already tell by Ryan and Melissa, they're kind of giving me the silent nod, like, okay, high level, dude. But, you know, supply and demand as an example, there are 17, if I remember right, close to 17,000 units underway right now in the Houston market building, right? You compare that though to their market average, which is 25,000 units is their market average. So we're already below what their average typically is. And their vacancy rate is also 7.8%, just under 8% vacancy. In that market, the average vacancy rate is usually closer to 10%. So their vacancy is lower, which means there's a ton of demand, and their new builds are also lower, which means there's way more demand and less supply, which is why rents continue to increase in that market and in a lot of markets, but Houston specifically. So hopefully that answers that question.
So you touched on the market. What about the property stress test?
There's a bunch of factors, tons of stress tests or factors or whatever you want to call them that we look at with the property. I'll go very high level here too, but location of the property, the age of the property, the financials, obviously, is the first thing that we look at above anything. Competition, you have, you know, the neighborhood that it's in, the business plan. Is our business plan going to be a fit in that market? Returns or risk return analysis is obviously, you know, the biggest thing. Is why I say the financials. And once again, I won't bore you with all those details, but it's a lot. We look at, I don't know if any of you have ever seen our underwriting spreadsheets and our templates and our due diligence templates, but there's a lot of metrics we look at to pass the stress test of these properties, and that will never change, man. That's how we've been able to exceed the returns, that we project and have the return and the track record that we do. So.
Hey, really quick, Melissa,
Absolutely.
I like this question on here. Someone just asked, are those gross or net returns? Right? We're just happy to say those are net returns. I mean, all fees were already paid out. Those are what our investors made on these deals. So, and I think that's what's super impressive of the deals that we look at, the stress test that Tyler's talking about, all the other factors as well. So, yeah, those are definitely net.
Absolutely. So, Ryan, Tyler started to talk a little bit about underwriting. I want to know.
Hold on one second.
Yep.
I just saw one in the chat. I'm sorry. Vanessa, she says, I'm a behavioral scientist and real estate investor. Fear mindset is paralyzing, and fear motivation builds mastery and propels forward movement. I love that. That's exactly it, man. I love it. Fear it's all how we view fear, man. Fear is, if you look at it as a bad thing, it can be a bad thing, but it can also heighten your senses to make sure that you find the solutions, to make sure that you're protected and continue to grow. The riskiest thing is to not move forward. That's the riskiest thing. So, sorry, keep going. I'm sorry. That I love that too.
Yeah, that was awesome. Vanessa, he's going to steal that from you, right? He will absolutely be using that from now on. Now, Ryan, so I was going to ask, Tyler started to talk a little bit about underwriting. I want to know what you specifically look for on the underwriting side of things, since you're our go-to numbers guru.
So, some of the things we're looking at, obviously, occupancy. There's things that we looked at 3, 4, 5 years ago that maybe we look differently now. For example, like delinquency. You see a lot of times, we're still, combating some of those things with COVID, right? And people not paying their rents. When we get into a property and we look at those underwritings, We're making sure that people are paying their rents. If they're not paying their rents, what is the current management's policies or procedures of collecting rent? What things, like on one of our properties, we hired a social worker to be able to go and collect rents. We're constantly looking at, like in Texas, United Way, right, to be able to pay rents. In the Carolinas, different company, different, not-for-profit companies that help out. So we're always looking at delinquency as well. We're looking for value add opportunities. One of the great things with our properties and our management teams is we incentivize our management teams to increase those NOIs. In fact, we were joking about this last night, right? We buy one of our managers, Carol Ann, we bought her a Louis Vuitton purse, and she always wanted a Louis Vuitton purse. And so we got her Louis Vuitton purse. She's got shoes as well, and so it's crazy. We like to get to know our management team and what.
Wait, I have to ask you, Ryan. I want to know, did you Google how to pronounce Louis Vuitton?
Louis Vuitton or Louis Vuitton? I mean, because those are two separate things, right? So she was trying to get me there. She was trying to get me. She just bought Louis Vuitton shoes, so red bottom shoes, So, hey, listen, I've had to learn to step up my game, as far as dress goes, but that's just because we bought these shoes for people, I didn't know that $800 pair of shoes existed, but they do. So no, but we're looking for value add opportunities, ways to increase that, ways to decrease vacancy, right? I mean,
hey, can I mention something with that, Ryan, real quick? Because I just want to clarify, like, it's understanding you're creating the right environment on how to incentivize. So the example, and Ryan will laugh at this because I talk about this all the time, but it's creating the environment, right? If I want you to put a sweater on, I could tell you, or my property manager, whoever, right? Put a sweater on. And I can't control or force anybody to do anything. But if I can control that environment, and I turn that AC down to 60, well, that person's going to go put a sweater on without me even having to say anything. Same thing with our property management companies. If we create the right incentive structure, they will do the things that we need them to do. And this is, if any of you own businesses at all and have team members that you work with, this is critical for you. You create that environment and they will do the things that you need them to do without you even having to tell them to do it. That's the powerful thing. So why do we incentivize her with the things that, these purses and whatever? It's because it's what she wants. But number two, we incentivize. So many people will incentivize their property management companies solely on income, but they forget that the property is valued by net operating income. So we want our like Ryan was just saying, we want our property management company to focus on increasing income and lowering expenses. So if they increase and they hit these NOI thresholds, well, our values increase massively. So do our returns, and that's your returns. So that's why we incentivize that way. Sorry, Ryan, I had to use perfect intro for it, man. I had to. I had to.
Oh, that's great. I love it. Someone just asked a question that fits right in line with the underwriting. Did we ever lose money due to COVID? Absolutely. We lost over 100,000 on one of our properties. Does that hurt? Sure, right? But when we talked about forecasting earlier, part of forecasting is counting into our underwriting. We account for a certain percentage of physical vacancy. We also, take into account economic vacancy, right? And so we just don't go, hey, listen, if the property runs at 95%, brokers come to us all the time and say, this is at 95%. I know we go to a market on a property, if it is 10 or 15%, we're going to account for that. And then, what we do is we're going to really grind and stabilize that property in the first 12 months. So the individual who asked that question, sure, we lost money. Did we account for some of it? Yeah, for sure we did. Were we profitable? Are we selling that and making good money on it? Absolutely we are, and so, but it's all about forecasting and putting those numbers in and then getting together. Now, here's the thing. If I can go in and it has too much delinquency, maybe the demographics of that property don't fit what our criteria is, then we'll back out. We just won't do the deal. We're not going to just jump in and do it. And so that's super important in our underwriting process. The other part of underwriting in the process is really looking not at current numbers, but really looking where we're going to be at in years, in the 12th month to the 18th month. Some of you guys have asked, how are you going to sell your properties off in the third year? Well, how do we do it? Is because we're stabilizing, in the first 12 months is what we tell you guys, but really we're ramping that up within 6 to 12 months so that, the 12th month to the 18th month, I'm a huge golfer. They call Saturday moving day, right? I call my 12th to 18th month moving day, right? It's our moving time where we can be as aggressive as possible right, to ramp up rents after we've stabilized those properties, so that between the 18th month and the 24th month, we can go, hey, listen, Tyler, look, we're going to get with you. Hey, we should probably sell the property at this point, you know? And that's when we're going to make a decision if we're going to sell that property before the 3rd year. So that's all part of the underwriting process.
You know, so much of, I just mentioned one more thing, sorry. So much of life and business and anything is not necessarily what happens to you, it's how you react to what's happened. So the reason that some operators lost money and didn't rebound is because, well, they didn't rebound, right? They just focused on what was happening instead of what they could do. So it's focusing on the controllables, what you can actually control, instead of being overwhelmed by the uncontrollables. So sorry, Melissa, you're gonna say something though.
Well, no, I was just going to say, you mentioned the 3rd year. Now, we talked about how we plan to refinance and return 100% of investor capital by year 3 from the fund. Can you explain the plan to refinance and why that's so powerful, Ryan?
Yeah, and I think Tyler hit on it earlier on in the presentation, right? Is you know, refinancing out. Here's the thing: we put our money into this as well, right? And so we want to refinance for the 3rd year. You know why? Because we get our initial capital and then let our other capital, right, our return of capital, work for us again, right? So we're going to put that into another fund, more projects, to let our money work for us, right? You know, the wealthy get wealthy. Why? Because they let their money work for them, right? We want to refinance these properties like we talked about, you know, between the 18th to 24th month. And we're looking to see if we can sell them, you know, and that's where we're going to have a good idea, is if we can sell these properties off and then get you your return of capital. So yeah, I mean, absolutely before the 3rd year. Our track record shows it. I don't think that we've really held any properties longer than 3 years. You know, most of the properties we've sold in the 2nd year, and they sell, you know, what Tyler, 30 months after, so 2.5 years after we've owned them is typically when we're selling these properties off.
Tyler, I'd love to hear your perspective as well.
I just think we have a phenomenal investment model, you know, like, so if you really think about the investment model, we go and we buy these apartments. So paint this picture for you. We buy these apartments with our connections, right? The lending, the debt on the property, we go and source that debt. You know, we go to Fannie Mae, Freddie Mac. We're a preferred borrower with Freddie Mac and Fannie Mae. And so we put those debt pieces in place. We oversee the purchase process, you know, relationships with these brokers, negotiating the deal, structuring the deal. We bring our operating team in to operate the deal and do the due diligence and asset manage the deal. And then we bring investors in, right? So investors to participate in the deals to cover the down payment. So let's say that down payment is, you know, 25% as an example. Okay, so we bring in investors. We have thousands of investing partners, thousands. So we bring these investors in, they partner on this deal, and then we take the operations and we drive the values up over the next 3, 5, 7 years, you know, whatever the business plan is. And then remember, these properties are valued like a true operating business by the cash flow. So as we increase cash flow, well, I'm going to ask you in the thread, and I want you to type to make sure you're following along here. As we increase the cash flow, what also increases on that property? Type it in the chat box. Gordon, good to see you on here as well. We'll get those questions here in just 1 second too. Net operating income, which increases the value. Yep, there we go. Tons, there we go. They all popped in. Net operating income, then the value of the property. So think about this. Now we go back to Fannie Mae, Freddie Mac, or whoever the lender is, right? And we're like, hey, the loan's about to expire. Would you like to do another loan on this property? You know, because the income is increased, so is the value. We're going to give you the same amount that, you know, that they'll say, we'll give you the same amount that that you owe on the property, plus 25% is the example I gave earlier for the down payment, plus that initial 25% that you put down, maybe even more depending on how much we've driven the value up. So then I believe this is where the magic, I know this is where the magic happens. So a bunch of questions on what happens when you exit those properties. Well, we refinance. The capital event is refinance. So what we do is we take those proceeds that we put in. So yeah, another question, how much are we raising on the fund? It's a $20 million fund. So that 25%, right? $20 million. We now distribute that to investors. So if you invested $200,000, you would get a check for $200,000. Now, how much taxes do you pay on that $200,000 that we just gave back to you? Type that in the chat. How much do you pay on that $200,000? Zero. All right. It's a return of capital. It's zero. You're going to take that to your accountant. Your accountant's going to be like, well, there's no tax liability here. And you're going to be like, shit, I should have invested more money into that freaking fund, you know? And then you're going to take that 200,000 or whatever it is and invest in something else. But you still, and this is where the question comes in, it's typically like, okay, but now how much of that property or the fund, if you will I still own? And it's the same ownership. So you have zero money in now, and you still get the same future up, this long-term growth, right? Cash flow, equity growth, and that just continues to roll and roll and roll. And, you know, I mentioned this earlier, but how is this different from a REIT? You won't see a REIT on the planet that structures their investments that way, on the planet. And listen, there's plenty of people who invest in REITs. It's not a knock on REITs. There's plenty of people who invest in REITs and are happy with those returns. But we are a smaller operation. We're still a pretty decent operation. You'll be hard pressed to find a syndication group that has the employment base and everything that we have, but we're smaller than a REIT, that's for sure. And so what do? These relationships, you know, y'all on here who have invested in, we know y'all on a personal level, you know? And so it's a team effort. We're also investing our own funds in, like, we want to benefit the same way, man. So it's that long-term growth that obviously protects downside, you know, increases your upside. And so, yeah, I just believe we have one of the best investment models out there, period. It's because, you know, it's a very fair investment model. That's my opinion. So does that answer that question?
Absolutely. It's awesome. So I do want to make sure we have so many questions that are coming in. So I want to make sure I get to your questions, but before we open it up to the Q&A, I want to make sure that you guys know if you have questions about the fund or are looking for the business plan or specific return metrics, or you're wanting to complete your subscription, Tasha will drop the link in the chat and you'll be able to see all of that just from that link. So the first question I want to ask you guys, it's from Ginny. She has a couple questions. So the first one, would the tax benefit be the same if she joins the fund compared to doing the individual syndications?
Right, that's right up your alley, bro. I know the answer, but right, you just went blurry on us, dude.
Blurry, there we go. I came back. I mean, it might have been all those drinks I had or something. I don't know, man. No, so is it the same as a syndication? I think I answered the question on it. But you know, our fund is very similar to the syndication model, right? Where, you know, those tax benefits are going to trickle down into all the investors as well, right? Here's the thing is a lot of people, when they do funds, you know, I said this last night, you know, maybe it was the wrong word, but I'll use it again, right? I think a lot of people that do funds are selfish, right? They want to take the money in themselves, right? And that's a large part of it. They cap it off at 20%, 24%, you're done, you're out. You know, we don't do the same thing with you guys. We want you to benefit in the upside as well. So we're doing it very similar, you know, to the traditional syndication model. All we're doing is we're putting more, you know, properties in that fund for you guys so that you can diversify your assets.
Yeah. Why do we do that? It's not just because we're nice people. We are nice people. Well, some of us.
Some of us.
It's because we want you to continue to invest. There's a reason that our investors, that we've had investors invest with us on every single deal. It's because we want you to continue to invest. You want to know why? Because it makes our job easier every single time. So it's, once again, abundance mentality versus a scarcity. A scarcity mentality tries to hoard everything, where an abundance mentality knows that if we can continue to give you tax benefits and solid returns, you'll continue to invest. And that makes our job easier and easier. And that's how we've been able to scale and grow the way that we have.
Awesome. So the next question, when we're promising 20% and the properties sell better than 20%, would the back end be distributed, and would it be distributed how it has been, or just the promised 18%?
Yeah, so it's not a promise. Real estate's a risk. There's always risk. I want to be very clear. There's risk associated with any investment out there. It's our job to mitigate it, obviously. And obviously that's why you invest with us, is you believe in our ability to do that. But I want to be very clear. It's not a promise. If it was a promise, it would be a debt and you'd make a lot less than that. But it is, you're a partner on the deal. You get paid from the returns of the deal, just like we get paid from the returns. But to answer your question, the upside past the 20, yeah, it's, you still participate in all that. We don't cap you. That's kind of what Ryan was saying, is So many people will cap the equity returns at a certain point. We don't. I'll tell you what we do though, is anything past, and we've done this on every deal, but anything past a 20% is then split 50-50. Anything before that is split 70-30, but anything past 20%, then we've performed in a way that now we are able to take 50-50 returns from there. Once again, that's also why you see our returns higher than our projections. We want our returns to be higher than the projections. Once again, obviously that's a great thing. So yes, you participate in the upside, the short answer to that question.
Awesome. So Jesse asks, how long is the wait from when you first invest until we receive our first payout? And I did see that question was answered in the chat. So it's the third quarter after close. Just so I don't know if you guys have anything else you want to add to that, but I did see that was answered there.
Yeah, I'll add one thing.
Okay.
So many people. One of my questions that I ask when I go to passively invest in other options, I'm a passive investor just like y'all on our own stuff and other stuff. And I ask that same question, but then my question will be, how come third quarter? And it's a strategic question because I want to know why third quarter, but it tells me a lot about the group. I'll tell you why it's third quarter for us. It's because it doesn't mean that those returns aren't accruing. Those returns are accruing. So your preferred return is accruing. We're just not paying out until after the third quarter. And why is that? It's because we don't want to just pay returns willy-nilly. What we want to truly do is stabilize the property, make sure that things, once again, operations or properties, there's multiple properties, but stabilize, and then we can start paying returns. Our job is definitely to give returns in the short term, but the overall job is to give returns in the short term and protect that long-term growth and protect your investment capital. So some time for stabilization, then we start to return. But those returns over those months are accruing, and you'll either get paid that in other quarterly returns or made up upon exit. So that's why.
So talking about exit, Tyler, Jesse also asked, what is the exit strategy and what is the number of years until we exit the fund?
So the capital event is projected to be 3 years that we give everyone 100% of their capital back. And honestly, we project that there'll be more than just capital back. We believe that there will also be capital plus equity that we return. But as far as when do we close the fund, it's the same. We always do 3 to 5 year projections. And why do we do that? It's because it's very difficult to project past that process, or that confidently project past that amount. But really, I mean, we're always playing the market, always looking at risk return. And just because we exit a property doesn't mean that we have to close the fund. We can buy another property within that same fund that you would also benefit from as well. And Ryan, I don't know if you have a better answer that's more of a tactical answer than that, but.
Pretty good to me.
So another question, Gene asked, how do you calculate the back end return on the equity piece at closing, which is a great question. And I know a lot of our investors that are used to the syndication model have that same question. So will each property have a different equity amount at closing? Brian?
Yeah, not one property is alike, right? I mean, each property we go after is very different. I mean, you look at, in the portfolio that we're selling right now, we bought one at $7.5 million. We're selling it at $15.1 million. Another one we bought at $34 million. We're selling it at $44 million, right? I mean, every property is different, and we may hold on one property for a year. We may hold on to one property for 3 years. And so just every property is going to be different. You're going to get the calculations going to be based on what your ownership percentage is.
So remember, you don't just own one property. You own a percentage of all the properties within that fund. So you benefit from all those. So how do we calculate it? It's what the true return is. We don't skim or I don't know the best word to use, skim off the top, or we can once again cap. No, it's a true return. It's a true split 70-30, anything past 20%, 50-50. So.
And that actually touches right on what Doug Landman says. He asked, what do I own in the fund opposed to ownership in a single syndication? So you answered that perfectly. 2 in 1. It's great. The next question I have is, will investors receive one K1 at the end of the year or several for the Akahi Fund?
Yeah. answer that, right? This is probably your favorite part given right now. One thing that I'll say real quick is we talk about learning and we talk about growth. We talk about the investor experience, as we continue to grow. Well, and we're passing out a whole bunch of different K1s and having to deal with all that in different raises. It actually eliminates from the user experience, the investor experience, right? The overall experience. Even though returns are great, if we're lagging on some things, it diminishes that experience. And so we've realized that we have outgrown our accountant. We have now got a whole new accountant, a whole new firm to make those processes more efficient and effective. And a fund makes the process way more efficient and effective along there. And then Ryan, I'll turn it to you so you can answer the
I think about it. I mean, it's like you said, we do a lot of syndications and kept our accountant busy. But the great thing about a fund is it's 1K1 that you get. We'll have those done by January 31, which make things a lot easier and a lot of our investors a lot happier. So yeah, just 1K1.
Yeah. Hey, I'm curious, all of our investors who are already on here, give us a thumbs up if you like it or a thumbs down if you would rather continue to get 1 million K1s. What would you prefer? Throw them in, yeah.
There we go. Love it. Yep.
No question, man. It's way better. So.
Okay, so there are a couple other questions, but
I love these too. It's thumbs up and it's like, thank God.
So Tom, I know you have a 1031 question. Tasha will put in our contact information. Why don't we jump on a call and we can discuss that where we're out of time here. And then also Jasmine, I can see that you have a question as well. Tasha will put in our contact information. We'll jump on a call with you. So I think with that, you guys, go ahead.
I just want to clarify why that's the case. It's not necessarily that we're out of time. It's because that question, Tom, is a very detailed and minutia-based question that we will absolutely reach out and answer for you. But this may not be the best setting to do it. So we'll reach out and answer it for you. And then the other question was, we have to have 100K to begin the process. Yeah, as the passive investment, our minimum is 100,000 on this fund. Yes, that's the minimum.
Hey, one question I wanted to answer for Gordon is he said, I think he asked, it's quite a few questions up, but if we've seen an increase in occupancy per unit, yeah, we've definitely seen an increase in occupancy. Not only that, we've seen a decrease in bad debt, right? In delinquency. So I think that's the bigger question we want to look at is not only occupancy, but are people paying? And so we've definitely seen an increase in people paying and less people not paying. And so, yes, that definitely has an effect on our NOIs. So if you look at the last 3 months on most of our financials, our NOI has gone significantly up.
Awesome. All right, well, we'll go ahead and wrap this up. Ty, were you wanting to jump in again?
Oh, no. I was just going to say, I'm sure you're going to go through some next steps and stuff, but
yes.
More than anything, I just want to show gratitude. We're very grateful for and I'm sure you would say this too. I just grateful, man, for all you who are, investor partners in the past and continue to partner with. We would never be where we're at without y'all. So I just want to be very clear. We're very, very grateful for y'all. And that's not just something we say. Those of you who have been investing know that. Those of you who maybe this is your first interaction, maybe you don't know that, but you will. We're very grateful, man, for real estate and what it's done in our lives and for our investing partners, and grateful for y'all. So that's all I wanted to say. I'll let you take it. Sorry.
No, that's exactly what I was going to say. And on that note, we're grateful for you guys. We're grateful for you, Tyler, for you, Ryan. We know that your voice is getting a little crackly. So you've spent the last couple hours going over this for us, and we're super grateful for you guys. So thank you. But most importantly, to these investors that are incredible, who've stayed on with us, thank you so much. Again, if you have any questions, please don't hesitate to reach out. Just an update or a reminder, your next steps, the link, if you follow the link, that will take you to your data room, which will give you the business plan and all of the details for the fund. That's also where you'll be able to have our contact information and ask any questions as well. So again, we want to hear them. Please don't hesitate to reach out and let us help get you some answers. So we look forward to putting your money to work and really being partners in this.
Love it. Okay, thanks y'all. Take care.
Thanks, you guys.
Don't feel shy to reach out. Thanks so much. Thanks, Gene.
See you
You're
later.
a rock star, bro. Appreciate it. Jesse, So good to see you too. All right, thanks, Bradley. Tasha, thank you for dropping the links in and taking care of everybody's questions on there. I saw you busily engaged on the chat. You're amazing. Zach,
Yes.
hey, and Vanessa, dude, I didn't realize that was the same Vanessa that I chatted with at Peak Partnership, man. That's awesome. That's awesome. It's good to see you. Odie, thanks so much. All right. Thanks,
Awesome.
y'all. Take care.